Still staying with China now, we know that China is sitting on massive forex reserves, both in dollars and in euros, and it's going to need to put this money somewhere anyways. Do you think China is just trying to take credit for something it's going to eventually have to do? Talking about buying Italian bonds or making it look like, okay, we are going to buy Italian bonds or some other European bonds to help, the Eurozone. They have these massive reserves that they've gotten from trade surpluses over the years. They're going to have to put it somewhere.
I do not think that China is, I cannot say totally what the motive of the Chinese government is, but I do not think they're trying to take credit. I think they're just obeying the simple principle of buy low, sell high. If you remember how Warren Buffett invested in BofA and invested in Goldman Sachs, and he ended up getting about $200 and something million in income when BofA declared dividend, and Goldman Sachs came back and told the Federal Reserve they were going to pay back the people who helped them in the financial crisis. I think China is just realizing that these nations are not going to fail eventually. They are going to come back after they make tough decisions, and it's going to make a lot of money from the bull run. And I think going forward, the Chinese government will invest in more emerging economies than developed economies.
And let's still stay with China. It's it's funny to be quite interesting this week. Now, some analysts are also saying that China has all these reserves, as I mentioned earlier, because it's running trade surpluses. Now, one of the problems that one of the reasons why Europe has found itself where it is today, talking about the debt crisis, is because it's having a growth deficit. And part of the reason why it's having a growth deficit is because it's having trade deficits in China. Now, they're saying that if China is genuine in its intentions to help Europe, instead of sitting on all this, instead of having all these trade surpluses and putting the proceeds back into Europe to sort of put Europe on a lifeline, why not, invest in Europe to help create jobs and, like that?
Well, I do not think China can bring back the European economy. Europe is going through a period of lull. It happens when, there are basically four stages. There is a boom stage, there is the growth stage, there is the peak, and then there is a consolidation. Europe and America is going through a period of consolidation where GDP is nearly zero and just above 1%. I think China is going to slow down. I think China's growth to slow down when, especially
GDP rate of about over 7%.
Yes,
every year.
I think the Chinese growth rate will slow down in a couple of years when this they're included in the special drawing right, and when they have no choice but to move the exchange rate from fixed to floating. When the market determines the value of the yuan as an exchange rate, and it begins to price, and China begins to calculate how much is earned in GDP from the export of goods from China, I think growth will slow down a little bit in China. But the only other area where I think the Chinese government has been smart to avoid having a bubble is in shoring up the official requirements and the capital asset ratio of financial institutions in China. It's trying to avoid a repeat of what happened in the US and in Europe currently.
Okay, we'll come back to that, Kelvin. We need to take a short break now. I've been speaking to Kelvin Emmanuel, a global market analyst from Stockholm. We'll be back after the break to continue with the program. Please join us again.
From the secret